Well, I first came to Ron Paul in 2007. I just never heard of him before that point, and the big issue for me was the Federal Reserve. I am an investment advisor. I've been one for a while now, and I watched my clients get no return on their investments in fixed income. And there was a reason for that. There are some wonderful centralized planners out there at the Federal Reserve, a private organization that doesn't have any sort of public auditing or oversight by Congress in any real sense.
And they have a money tree in their backyard.
Yeah, they got a money tree in their backyard, right? They get the idea that they know what the best rates are for the marketplace, right? Well, if you know what interest rates are, it's really actually a price. It's a price it costs to borrow money, right? And every Republican seems to be against price setting until it comes to the Federal Reserve. Now, I see the low end of the price setting. I see it hurting my savers, the people I work with on a daily basis. It helps the people that are making the foolish mistakes of going into debt, the college students, the people buying houses they can't buy, the government not balancing a budget. So,
and it helps create more debt.
It creates more debt, exactly, and incentivized debt when we need incentivized savings. But the marketplace would do that in natural cycles. And so this is the problem with the Federal Reserve. There's not any candidates out there, or any politicians out there, other than Ron Paul, that really talk about that issue. And I had a lot of hopes in Bachmann, Michelle Bachmann here in Minnesota, who used to be my congresswoman until that switched due to redistricting, because she seemed to have that idea. And I've talked to her about Mises and Hayek and the Austrian School of Economics, and I think there's some room for her to understand that side. But there's no leader out there that understands the problem with centralized economic planning like Ron Paul. And people, if they don't understand this issue right now, will understand it in the next coming years, because we cannot continue down this road of high debt.
Well, they should understand it by now.
They should, but
and a lot of people are at least asking the right questions now.
They're asking the right questions, but they don't understand the solutions, and that's
Exactly.
what I do in my private practice. I explain to them in detail what's going to happen with this debt explosion. Now, that message resonates with Republicans. It certainly resonates with libertarians. You could probably help me define that. But there's actually a party, the Democrat Party, that, and a school of thought in Keynesianism, that debt's actually not a bad thing. In fact, it's a good thing. And that's really bad. That's a very poor explanation of the crisis we're facing. And the real problem here with our economy is this false sense of safety, what we call the moral hazard. And we saw that happen in the housing market. And we're seeing it right now in the bond market. I know a lot of people in the investment world still say the treasury bonds are the safest investment, and I think that's bad advice.
Yeah, well, some of the best economic advisors that I've heard over the years, and when I say best, their track record is they've been right.
Yeah.
You know, the things that they were predicting came true.
Right.
A lot of them,
not
one of them have warned that, you know, because people, they'll ask doomsday questions, you know, when's the big crash? How, you know, what's the sign before the big crash if it were to happen here in America?
Yeah.
And they say, the answer I've always heard the same from those who are right,
Yeah.
is that when you see the bond market fall,
Yes.
watch out.
Yes.
Oh.
Well, and this is what I do, and this is my research here, and I will actually be publishing some of my research here in the next couple of weeks about this very instance. When the way the bond market works here, and what I'm talking about is the treasury market, is there is buyers and sellers in an auction, and this happens on a weekly basis, and they have different maturities that come up in the treasury auction. Well, the buyers out there are many different types. You have an institutional investment, big institution investors. You have foreign investors, China, Japan, the UK. You have intragovernmental, non-competitive bid investors, which is like Social Security Trust Fund that buys our debt, which is a problem in and of itself. And then recently we've seen that the banks and the Federal Reserve directly have been part of that buying process. So you've got a bunch of people buying these treasury bonds. Eventually what happens is when a investment in the fixed income arena becomes more risky, for whatever reason that is, but generally speaking, we're talking about governments, it's because their debt becomes too high, and right now the debt is too high in America. It's over 100% GDP, and our credit ratings have been lowered by some of the reputable credit agencies. In order for investors to continue buying that debt, they need a higher rate of return. Okay, so more rate of return for a higher level of risk. It's generally how the credit market works. So eventually what's going to happen is they say that enough is enough. We won't buy treasuries unless we get a higher rate of return. That's a market mechanism. The reason it hasn't happened yet is, relatively speaking, around the world, America still looks pretty good to most people, but it's not. But that's the general perception. There's safety in the dollar, and when we say safety in the dollar, it means people are buying treasuries. So this point will come where they say we need a higher rate of return to buy your debt. And so when that rate goes up, we have a very catastrophic problem. The amount of money we will owe on net payment on the debt will go up with that, right? If we're borrowing if we have $15.5 trillion in debt, which comes due at different maturities, and we add another $1 trillion each year, that money at low rates is a roughly low interest payment. But when that interest payment goes up and that debt still stays the same level, those payments will rise at catastrophic levels. And we could see where we're at right now with 10% of federal revenues going to interest payments on debt. We could see that spike up to 40%.
Yeah, that wouldn't be good.
It wouldn't be good because Social Security, Medicaid, and Medicare make up 65% of all federal revenues. And I'm not talking about our budget. I'm talking about revenues, what comes in the federal government. So that's 105%. So we're already overspending there. We're going to be forced at a point here in the near future where it's going to be close to $2 trillion we need to cut out of our budget just in order to provide a national defense, the number one role of the federal government.
Mm-hmm.
You don't want to make cuts to Social Security? Okay. Then you default on the debt. Well, guess who owns some of that debt? It's in the Social Security Trust Fund. You have to make cuts, and we're coming to that point soon. There is another option for the federal government, and that's the more dangerous option. The Federal Reserve comes in and they say, we'll continue buying at these low interest rates, but they don't have the money to do that, and that's called credit creation. Quantitative easing is the term that it gets labeled here in the media, and we say QE1, QE2.
It's just increasing the money supply.
Yes, QE3 could be the big devastating part. They've just become the lender of last resort, and they're the only ones buying those treasuries. That keeps the rate low, keeps the debt manageable, but guess what happens to prices in our economy? They go sky high.
Yeah, eventually they just run it into Zimbabwe or what's the classic one that everybody always...
The Weimar Republic in Germany.
Yeah. I got a question for you. Would you... Now, this is something that I believe, and I'd be curious to see if you agree. Do you believe that a sovereign nation has the right to create its own money and owe nobody for it?
Yeah, I mean...
Because isn't money just supposed to, I mean, at the simplest terms, I mean, going back to ancient times, isn't money just like an agreed upon denomination for people to trade amongst each other, right?
It's used for exchange, it's a commodity.
Yeah, it's a denomination that represents an asset. It
Right.
has value, right?
Yes. Yep.
But our system today with the Federal Reserve,
Right.
they're making dollars of debt.
Right.
Because every dollar they print, we now owe a dollar
Right.
plus interest.
Right.
But even if we didn't owe the interest, wouldn't that eventually lead to losing all our resources to the entity that is making money out of thin air and, then lending it to us?
Or it ends up in war and you have to protect your national resources. No, I mean, you're under a point. What we're talking about here is fiat money. It's basically paper money that's not backed by anything, and it's always failed throughout history. It's never worked any time in history, and America's seen it actually before. We were on some kind of fiat system and during the Civil War where we inflated the currency quite a bit, and also prior to our Constitution and our founding, we were using some kind of continental dollars. That didn't work. And then slowly after that, what we ended up using in America was Spanish gold coins, right? And that was a big traded currency in the United States.
Mm-hmm.
In today's world, there's so many options. We don't even know what it could be. The marketplace will decide what the currency will be. And if I had a choice, to answer your first question, yes, a sovereign nation can choose what they want to do, and they'll suffer the consequences. Me, if it's my nation, I am a free. I believe in the free market system of deciding what that exchange would be. And being a student of history, I think it would inevitably end up being gold.
Yeah. Well, I personally, I think that down in its simplest terms, what's most important is that the money represent wealth.
That's right.
And not debt.
That's right.
You know, and so whether it's gold or patty cakes or or whatever, I don't care.
Right.
You know, but it should represent some tangible
Exactly.
asset, real wealth. You know, maybe it could even represent labor, for Pete's sake. I mean, I don't care. Anything would be
Right.
better than what we have now, where it represents debt.
Yeah, it does. You're right. Yeah.
Yeah.
I mean, our dollar's not backed by anything, and it's a scary notion. There's no commodity, nothing that it's tied to, and that has to stop.
Jake, I can tell you, I gotta thank you for the opportunity
Sure.
to interview you.
Yeah,